Hey everyone, welcome to FinTech. So it's been a wild ride in the market over the past year, with growth stocks crashing at the beginning of the year only to recover and then seemingly crash again. But my stock portfolio is up a little over 20% since its low in July of this year, with many of my positions up over 50% since then. And in this video, I'm going to be revealing my top 10 stocks to invest in right now and my reasons for personally investing in them. And if you find something interesting in this video, maybe try sharing with a friend. Okay, let's start out by diving right into my Charles Schwab stock portfolio. So you can see on here now I have my actual stock portfolio pulled up on screen, and we can see that over the past month it has declined by nearly 18%. And if we expand out to the year-to-date view, things don't look much better, with the year-to-date being down by nearly 44% for the year. But it hasn't all been a steady decline. At the beginning of the year, we saw a massive crash in growth stocks, which I tend to invest in, and eventually the market hit a low on June 17th of this year, before my portfolio partially recovered up through August, and then very recently, since the start of October, we've seen basically a second crash in growth stocks. But as bad as things seem from looking at the stock price, the actual companies I'm investing in haven't reported any negative news, with most of the stocks seemingly trading down based on recession fears and high inflation. But with that said, let's just dive into looking at the individual stocks in my portfolio. So the largest position that I currently invest in is Datadog, which I own 330 shares of at a market value of $26,000, and that's off an initial investment of a little over $30,000. So we have a net loss in this stock of around $6,000. Now, Datadog is a data company. They unite a company's applications, their infrastructure, and their security all through a single pane of glass, basically a single dashboard. And if we look at their website, we can see some of their large customers such as Peloton, 21st Century Fox, Samsung, and Whole Foods. And while Datadog's stock price has declined around 18% this month, if we look at their revenue, they grew 74% in their most recent quarter, growing 78% before that, 70% in 2020, 66% in 2019, and 83% in 2018. The company's been going from strength to strength, recently being recognized as a leader in the 2022 Gartner Magic Quadrant for APM and observability. Datadog is also extremely sticky with their customers, where they see a net retention rate of 130%, meaning when they get a customer to spend $1 one year, that same customer is expected to spend $1.30 the next year, showing that Datadog has really good products that companies are paying more for than ever, even in a recession. Datadog kind of illustrates a trend that I've seen with a lot of the companies in this portfolio, where they're generally seeing extremely positive earnings numbers, and yet the stock price is declining, which again goes back to my theory that this decline has more to do with the macroeconomic environment, while the company fundamentals are still strong, meaning eventually we would have to see a rebound. And make sure you watch the whole video, because I'm also going to go over all the trades that I've made in the past month at the end. Next up, we have Snowflake, which I currently own 160 shares of at a value of $25,000, and that's down around $5,000 off the initial investment I made. Now, Snowflake is a somewhat newer position for me. They are also a data company similar to Datadog, but they operate in a slightly different space. 100 years ago, people kept track of their data using manually written spreadsheets. Then that moved on to the computer spreadsheet. Then that moved into big databases, and then data warehouses, and then data lakes. And right now, most data is stored in the cloud, but Snowflake offers another order of magnitude improvement over all those other solutions. Snowflake calls its product the data cloud, where similar to the benefits that a cloud service like AWS provides to software engineers, Snowflake can provide that same level of service to data engineers, letting them control access automatically, or let you collaborate with workloads across the entire world, or even monetize your data in ways that you couldn't before. If we look at Snowflake's earnings for their most recent quarter, their revenue grew nearly 30% for the quarter, and their net profit margin was 35%. This is one of the fastest growing companies that I've seen, especially considering they're making $500 million in revenue per quarter. Now, because Snowflake's success story is so obvious, they have a product that everyone wants, they make their customers more money than they cost them, and they're basically doubling in size every year, you kind of expect them to be very expensive in terms of their stock price, and that is definitely true. If we look at Snowflake's price to sales ratio back when they first went public, they were trading at a price to sales ratio of 100, which is absolutely ridiculous and is the reason that I sold out of Snowflake after I initially invested. But since then, their price to sales ratio has continually dropped over time, sitting now at basically an all-time low of 28.94. At this point, Snowflake is being valued much more conservatively than they have at any point in their history, and yet they're still growing faster than ever on an absolute numbers basis. Snowflake has also recently introduced a new feature called Data Edges, where two different companies that are signed up for Snowflake's platform platform can actually share data along a data edge. So imagine a bunch of healthcare companies all collaborating on a product using Snowflake software. Well, guess what? Even if a recession hits, those companies can't leave Snowflake because then they lose access to all the data that they were sharing with the other companies. And it's extremely expensive to try to build something similar yourself. Number 3, we have ZScaler, which I currently own 112 shares of at a value of $15,000. And this stock is down more than my first two. It's lost in total nearly $12,000 since I first invested in it. Now, to be fair, Charles Schwab calculates the gain and loss a little bit strangely, so if I sold out at the top and then bought in some more, it's going to act like those gains that I had didn't exist and count it as more negative than it really is. So take those numbers with a grain of salt. ZScaler is a security company. They offer what's known as zero trust security. So in the old-fashioned version of security, you basically secured your network the same way you would secure a castle. You locked up all the doors to the outside and you checked everyone who came in and out to make sure they weren't shady. But once they were inside your network, they could basically do whatever they want. Zero trust security is the next generation of security, which is really built specifically for the cloud, where every single application, every person, every computer on the network has to authenticate before they can talk to each other. This means even if the bad guy is able to compromise one application, it won't necessarily spread throughout your entire system. Zscaler has maintained a rock-solid revenue growth rate. A year ago, they were growing at 62% year over year, then they grew again at around 62%. The quarter after that, they grew 62.5%, and in their most recent quarter, they grew 61.5%. And while the market seems to be reacting as if the recession is going to start bringing down these companies, based on the actual numbers and the data that we're seeing them report, they haven't really been affected by the recession at all up until now. Next up, we have the last of my large positions, which is Cloudflare, which I currently own 317 shares of at a value of $15,000. And this one in particular is kind of suffering because of the way Charles Schwab calculates gain and loss. It says I've lost $5,000 in this stock, but I've sold at a profit previously while Cloudflare was at a higher price, so this is definitely underestimating how much I actually made in this company. Cloudflare's goal is to make the internet itself run better. They started off just hosting websites and providing firewall protection for those sites, but then they realized if they're already analyzing all this traffic for bad actors, what if they use that analysis to also optimize the experience for good actors? They expanded into other services like a CDN service, and later started offering cloud services like their cloud workers, until at this point, Cloudflare is actually starting to compete with the large service providers like AWS, Azure, and Google Cloud Platform, which basically would have been unthinkable a few years ago. And Cloudflare's customers absolutely love them. They have a net revenue retention rate of 123%, meaning every customer they land this year will spend 23% more next year. And that's despite Cloudflare not operating on a subscription model. You just pay for what you use, meaning customers use more and more of Cloudflare's services every year that they're on the platform. Similar to Zscaler, Cloudflare has a rock-solid revenue growth rate. A year ago, we can see their revenue was growing at 50% per year, then they grew 53%, then they grew 53% again, and then they grew 53.8% in their most recent quarter. And look at what that actually does to the revenue over time. They made $234 million in revenue in their most recent quarter, and around a year ago, they were making $172 million. So despite the base of revenue getting larger, Cloudflare is continuing to grow at this very consistent pace, and they've been doing that same pace for around half a decade at this point. I know I've mentioned this in previous videos, but if you're interested in Cloudflare, I would actually recommend checking out the Cloudflare blog, where they write fairly accessible articles, even if you're not super technical, explaining what their products actually do. And if you're lucky, you can also find an article written by Matthew Prince, which is Cloudflare's CEO. He's a really good writer, and he's really good at breaking down some of these more complicated concepts into really simple to understand ideas. At the very least, you could read Cloudflare's annual founders letter with Matthew Prince, the CEO, and his co-founder Michelle Zatlyn. But now we move on to some of my mid-sized positions in my portfolio. The first of which is a company that has jumped a few places in my portfolio, because number 5 on our list is SoFi, which I currently own 1,900 shares of at a value of just under $10,000, and so far that's lost around $2,000 so far. Now, SoFi wants to be the digital bank of the future. They started out as just a lending business, offering student loans to college students across the country, but then they expanded into also offering financial services like their SoFi app. This includes everything from SoFi Invest, their investing account, to the SoFi checking and savings account, to the SoFi credit card. And now they also have their technology platform, based on 2 large acquisitions they had of buying the Galileo technology platform and Technisys over the last couple years. Now, SoFi is a little unique on this list because while high inflation does tend to hurt growth stocks because their future future revenue becomes less valuable, banks tend to perform better when there is high inflation in a recession. And SoFi has the benefit of offering the lending services of a bank. SoFi also has a somewhat unique business model that positions them above legacy banks. They basically use their SoFi investing app as a top of sales funnel to funnel their customers down into more valuable areas of the company, like SoFi's lending platform. And the value SoFi gets out of this is more than you might expect. SoFi uses what's known as the financial services productivity loop, where once a customer gets into the SoFi ecosystem, they tend to spend more and more money within that ecosystem and get more and more entrenched because they actually get more value from using more SoFi products. It's kind of like how an Apple customer will buy an iPhone, then they'll start buying AirPods, then they'll buy a MacBook, until pretty soon all of the products they own are Mac products. SoFi wants to do the same thing except for banking. And we've seen this actually starting to have a major effect on SoFi's numbers. If we just look at the average amount of money SoFi makes from a lending customer, well, they make twice as much if they have an app customer who then uses a lending product versus someone who just goes into lending directly. And one of the main reasons that I've been investing in SoFi so heavily recently is actually based on their stock price. So SoFi's had a massive drop in their stock price year to date. They're down around 68% overall. But if we look at SoFi's current stock price, they're sitting at just under $5 per share. This is significant because SoFi's book value is actually $5.50 per share, meaning if SoFi was completely broken up and sold off for parts, they would be worth $5.50 a share. This means that the market is currently valuing SoFi as if it's less valuable than its component parts, which is absolutely insane considering the fact that we're about to see the resumption of student loans, which is going to be a huge boost for SoFi, who used to be the leader in that space, as well as the fact that SoFi is currently growing at 50% per year in terms of their revenue. Apparently the market is putting no value on that whatsoever. In fact, they're putting negative value on SoFi operating as a company as it currently stands. So because of that, I've been investing more heavily in SoFi because I think it has the most short-term potential while also having the long-term potential of taking over the financial space. Now, the next of my mid-sized positions is Bill.com, which I currently own 74 shares of at a value of just under $9,000, and that's down around $3,000 since I first bought into it. Bill.com operates automated finance services for companies. So if a company wants to track all their different bills as a small business or even a mid-sized company or even as a specialized accounting firm, Bill.com has the software for them. One of the reasons I like Bill.com is they don't sound super flashy. I mean, they're just doing billing in the background. But if we look at their numbers, this is one of the most impressive companies in my entire portfolio. Bill.com has a net retention rate of 131% this year, which is actually up from 124% last year, which means their customers, once they get a taste of the product, just want to use it more and more. And if we look at Bill.com's earnings, they're even more impressive. Bill.com had revenue of $200 million in their most recent quarter, and yet they're growing at 155% year over year. That's a number that's so high, it's almost hard to comprehend. This doesn't mean that next year SoFi is going to have 50% more revenue. It doesn't mean they're going to have double the revenue. It means they're going to have 250% the revenue next year that they do this year. That is an unbelievable growth rate, especially for a company that's as sticky as Bill.com, and they're not going to lose those customers once they get them. If we look at Bill.com's stock price, they're down around 50% for the year, but if we look at how much they've recovered since their low, they are up around 22% since their low back in May. This is a company that I may add a little bit more money to as it becomes available. Next up, we have ZoomInfo, which I own 194 shares of at a value of $8,500 roughly, and that's down around $3,500 overall. ZoomInfo basically started out as a sales data platform where they had data for all the people who wanted to sell a product as well as the data on their customers, and they could connect those two groups. So it was a win-win because the salespeople found customers who were interested in their product and the customers got salespeople reaching out who had the solutions to their problems. But since then, ZoomInfo has grown into a much larger platform. They are now a B2B data and software company, and they have customers such as Snowflake, PayPal, Unilever, and Forrester. We can kind of see the extent of their ambitions by looking at how they define their platforms. They have Sales OS, Marketing OS, Operations OS, Talent OS. They basically view their software as the operating system that can run each of these segments of different companies' business. And based on ZoomInfo's consistently high revenue growth rate above 50% every quarter, it seems like they may actually accomplish their goal. The next company on the list is Crowdstrike, which is a security company. I currently own 52 shares of Crowdstrike at a value of just under $8,000, and that's lost around $2,500 overall. But speaking of business business security, running a YouTube channel is kind of like running a small business, and even at my tiny scale, security still matters. But I often struggle with creating unique passwords for every site and memorizing all of them, or wasting valuable time pulling out my credit card anytime I need to make an online purchase. Which is where this video's sponsor NordPass Business from NordVPN comes in. NordPass allows you to manage your company's digital wealth. How much time do you waste tracking down, guessing, or resetting passwords? Well, with NordPass for your business, you can store all your accounts accessed securely and access them from anywhere, even from your phone. Or maybe you need to make an online purchase. Well, NordPass can save your payments information for you, letting you share access with your team members without sending credit card details via email or an unsecured spreadsheet. Or saving you minutes, hours, or even days waiting to grant someone access to the company credit card. And ask yourself, how are updated credentials, alarm codes, PINs, and Wi-Fi passwords shared in your organization? Well, communicating sensitive data by instant messaging or email is not only a security liability, but a time waster too, often kicking off lengthy email to text chains just to confirm receipt. With NordPass, confidential information can be saved securely in one place and then accessed and updated by others when needed. So I'll create a secure note here, and then I'll share it with my team, way more securely than using email, and everything is managed in one place. Plus, it's super easy to sign up. Just go to nordpass.com/fintech and use the code FINTECH at checkout for a 3-month free trial to make your business more secure and more efficient. And now let's get back to my number 7 stock, Crowdstrike. So back to Crowdstrike, which actually used to be the largest overall position in my portfolio before I sold for some pretty substantial profits where I had seen 300% returns on some of my initial investments. Now, Crowdstrike is a security company. They operate almost like a super advanced antivirus that's bolstered by AI. Crowdstrike's real claim to fame is their Falcon endpoint protection platform, where they offer the Crowdstrike Security Cloud and then all of these different services on top of it which protect different parts of the business. So they have things like endpoint security, they have cloud security, they have identity protection, and they also have threat intelligence. So while a traditional antivirus basically just creates a database of previous viruses that affected computers and then scans incoming malware to see if it fits in that database, Crowdstrike uses AI to recognize patterns in these viruses to proactively protect companies. This has also allowed them to identify several zero-day exploits or virus attacks that have never been seen before they could affect too many companies. Here's just one example of an article written back in 2021 about several zero-day exploits that Microsoft reported, which Crowdstrike was able to mitigate automatically, detecting the exploits so that they could tell Microsoft there was a problem, but also protecting their own customers at the same time. As we see more and more businesses move into the cloud and the rise of just more digital businesses every single year, security is going to become more and more important. And Crowdstrike fits into that theme extremely well. Not to mention the fact that Crowdstrike is actually growing even faster than the security industry as a whole, increasing their revenue 60% year over year in their most recent quarter, while making around $500 million in total revenue. So this is extremely high growth at scale for the company. And with those two trends pushing them forward, just their organic growth from their customers, as well as from the shift toward more security in the cloud, Crowdstrike is perfectly positioned to take advantage of that. Which leads us to the second security stock that I'm going to talk about, which is Sentinel One. Sentinel One I own 274 shares of at a value of $6,000, and that is down around $7,000 off of my initial investment. So this is one of the biggest losers overall in my portfolio. And you might think that's because Sentinel One's product doesn't work or because the company is slowing down their growth, but neither of those are actually true. If we look at Sentinel One's actual product, it's very similar to Crowdstrike. They also offer AI protection to autonomously protect systems before viruses can actually affect them. But unlike Crowdstrike, which has already reached such a massive scale that they can't keep maintaining their hyper growth that they've seen before, Sentinel One is still growing extremely quickly, growing 124% in the most recent quarter, growing 109% before that, 120% before that, and 128% before that. This growth rate is so high that if we just look at the revenue from October of 2021 until their most recent quarter, we can see that their revenue has basically doubled in just 3 quarters. The reason Sentinel One is down more than the rest of my portfolio is really just because they've given up a lot of the gains from their recent recovery. If we look year to date, they're down down around 56%, and from their bottom in May 11th, they recovered all the way up to around a 50% recovery before recently declining down to basically erase all of those gains. This could be due to fears that companies will slow down security spending in the face of a potential recession, but we're also starting to shift away from that mindset as security becomes ingrained directly into the development pipeline of companies, using something called DevSecOps, where security is an actual part of the product lifecycle. And once that happens, you can't really just cancel your security subscription even if you're in a recession. Which leads us into the last position in my portfolio before I then go over the trades that I've made this past month. So my smallest position overall is called Upstart, which I own 124 shares of at a value of $3,000. And that is down around $25,000 from my initial investment. So this is by far the worst performing position in my portfolio. Now, Upstart offers an AI lending platform. So the traditional model of assessing risk is the FICO score, where you assign one number to a potential borrower to see whether or not they qualify for a loan. But Upstart does away with this one number and replaces it with thousands of different parameters that they can feed into an AI model to determine how risky a customer is with a potential loan. And you might think with the kind of stock price decline that Upstart has seen that their product doesn't work, but that's not what we're actually seeing. Upstart's AI model allows them to offer better interest rates to well-qualified customers or to offer loans to customers who would not qualify for a traditional FICO score. And they've continued to sign on bank after bank onto their platform because Upstart doesn't actually hold on to the loan once they originate it. They then sell the loan to other companies and they just get paid a fee for their service. And based on all the data we've seen so far, Upstart's loans actually default at a lower rate than traditional FICO score model loans, meaning Upstart's software does work, they're just being hurt by the macroeconomic environment that we're in right now. If we look at their growth rate a year ago, they grew their revenue 242% in a year. Then they grew it 247%, then 150%. But in their most recent quarter, their revenue only grew 18% year over year. Now, part of this is coming off the massive base of growth that they had a year ago, but the other part is the high interest rates and the recession that we're currently in. Now, I do fundamentally believe in Upstart's product. All the data is showing that it works, and Upstart is also planning to move away from just the personal loan market and into some larger markets such as automotive lending as well as mortgage lending, and in addition to that, they're also going to offer small business lending. Now, each of these steps is going to take time to happen, and I don't really expect Upstart to recover while we're still in the face of all these macroeconomic pressures. But once those do clear, maybe 2, 3, 4 years down the line, Upstart has the potential to grow explosively. It's just, in the meantime, they're probably going to keep trading flat. But that then leads me into the two big trades that I made in the past month. So the first big trade that I made this month, which you might not have noticed, is that I actually sold a fair number of shares in Datadog. Datadog at one point was worth over $30,000, and it at one point I think was a third of my total portfolio, which was just too much money for me. So I sold it down to put it more in line with the size of my second largest position in Snowflake. Now, at the time, I had no intention of deploying that money into any particular stock, but then I saw SoFi's stock price drop all the way down to around $4.45 a share. And I was just too tempted to pass up this opportunity when, like I mentioned earlier, they're trading below their book value. So I used most of the money from the Datadog trade to buy an additional 1,300 shares in SoFi, which roughly 4x'd my total investment in this stock. Now, the only reason I did this is because I do think SoFi has substantial short-term upside as well as that longer-term upside as well. It's not going to be my largest position like a Datadog, Snowflake, or a ZScaler, or a Cloudflare, but I think that it's worth investing a little bit more, at least for now, based on the fact that they're being so undervalued in the market. But I'm also curious what stocks you're looking at investing in right now. Here are my top 3 stocks in my portfolio, but let me know in a comment what your top 3 stocks are. So don't forget to check out NordPass using the link in the description for 3 months free with the code FinTech. Don't forget to subscribe and maybe share with a friend, and I'll see you next time.